Welcome to Connect, the podcast of California MBA, where strategy, innovation, and leadership come together to shape the future of mortgage finance. This is where the voices and ideas of our industry meet and we see real-world execution. I'm Paul Gigliotti, CEO of the California MBA, and if you're here listening, you're here because you care about building a better business for you, your organization, and your clients, and also for the future of housing. Before we jump into our chat, I'd like to thank our 2026 President Council sponsors, AmeriHome Western Alliance, Consolidated Analytics, Loan DNA, CMG Financial, Guild Mortgage, Rocket Mortgage, Wiener, Brodsky, Kidder, and Funding Shield. Without the support of these organizations, the California MBA wouldn't be able to do what it is that we do all day long. Today, I am absolutely thrilled and so excited for this conversation. I am joined today by John Hedlund, Vice Chair of ICE, Vice Chairman of National MBA, and also a very valued board member of the California MBA and friend of mine. John, thank you so much for being here.
My pleasure, Paul. Excited and happy to be here as part of the California MBA. Looking forward to
How
it.
about that introduction? You've got a laundry list of things that you're doing right now. You must be so completely busy and traveling all over the place. You just finished ICE experience. How was that for you, John?
It was great. It was I've probably been to, 7 or 8 of them over the years in various capacities, mostly with AmeriHome as a client, but my first one as an employee of ICE. So a little busier for me as an attendee than as a participant, but it was fabulous. It's a very well-run event, great feedback. It's not just ICE products. It's a large vendor exhibition, probably the largest of the year, 3,600 attendees, I
Wow.
believe. Just a lot of sharing, a lot of panels, a lot of workshops. So I think it was a great use of everybody's time who took a moment to join us at the Wynn in Las Vegas, which didn't suck.
Yeah, the Wynn's a beautiful place. ICE is an amazing organization. Before we move forward, I also want to give a shout out, John. You were kind enough to introduce me to some of your folks in the data analytics team. Just last Friday, I wrapped up a committee hearing for AB 238, the forbearance bill, and the folks at ICE were generous enough to provide additional data for me. So that might be an aspect of ICE that not too many people are aware of. So I want to thank you for having your team jump in and support us. It was greatly appreciated.
That's right. Yeah, I think seeing the use and the commercialization of data take off over the past, say, 5-10 years, but it's really growing. I think companies are understanding the importance, businesses. So we have access not only through the mortgage side of the business, but through all our indices and exchanges. We're involved in, literally millions of financial transactions a day,
Yeah.
various forms, and we are looking to create, data and information for our customers and clients to help them better run their business, manage the risks, et cetera. So an exciting part of the business. And you're right, probably not the most well-known on the mortgage side, but we're
And
changing.
now people will know about it through our Connect podcast, right, John?
Exactly.
That's
Now we're
right.
good.
Now you're good. So it was really hard for me to kind of narrow down some of these questions. I think I started with 10 questions, and our podcast usually runs about 20 minutes. And I know you and we've had business conversations, so I'm assuming that these questions will lead into other questions. But let's dive in because I really want our audience to be able to get inside your head. As we were just saying yesterday, you're not just eye candy; you're an extremely intelligent person, and we got a lot of stuff to go through. So I'm going to jump in with my first question. That's really around structural shifts, John. From where you sit, not from the headlines, but from the actual market data, as we were just talking about data, what structural shifts are happening in mortgage finance right now that executives may not fully appreciate yet?
Well, I think the first one is in the headlines to some degree, but maybe I'll take a bit of a different tact on this. So rates. and a pending refi boomlet. Probably not a boom, but we touched into the fives. We're probably closer to 6.5 today. When you look at Pratt and Tony's forecast, and even Fannie until recently, the lowest over the next 3 years they had rates on an annualized basis was last year.
Hmm.
So they're going up, 100 basis points or so this year, 100 basis points or so next year. And Mike goes out to 28 and he has it into the 6.5 range.
Wow.
So if people are thinking we're going to 5.75 or 5.5, could happen, of course, but I'm not so sure. And I wouldn't be betting on that to be my savior. Um, you know, so one observation, I'll give you a couple more. Um,
Interesting.
Somewhat related to that, obviously, all we've been talking about in this industry for 2, 3 years since the pandemic pushed, the price of an average home up 50+% or more in certain markets. Affordability has been a challenge. Then you overlay the inflation we've had over the past few years. It's a real issue for not only existing homeowners in many ways, as we know in the California MBA, fighting the home insurance due to the wildfires. I can have a 30-year mortgage, but I can't control what's happening to my property taxes in a lot of states and certainly my home insurance every year. And this is crushing people. So
Right.
we think about that. And then related, we think about, well, it's a supply issue. And I'm not so sure that's true. And I've talked to a lot of people in DC that spend a lot of time on this. We had this number, we're 4 to 6 million houses short. I'm not so sure that it's anywhere near that number one. And number two, in 5, 6, 7 to 10 years, we could have the opposite issue. Given just simple demographics, baby boomers aging out, moving on to their next phase in life, i.e., dead, you're going to have probably not the same supply issues. So there will be a natural correction. And I think the home builders are aware of that and they're not wanting to go too long in this space. So I think it's a difficult period. Maybe it's 3, 4, 5 years, but there's many markets, as you know, right now that are depreciating. If you take the top 100 or 200 markets in the US, the forecast for next year from many is 50% will go up a point or two, 50% of them will go down. So we're basically going to have a flat year, maybe up 1%.
Yeah.
So I think
Yeah.
it's starting to work itself out. It doesn't work that fast. If you're looking to buy a home today and you're outpriced, you're not priced in the market. I get that, but I think, you know, structural shifts and demographics are in the favor of adding to that supply chain over time.
So are
Another
you,
one I'll give you. Oh, go ahead.
I was just going to say, John, are you saying that we might have an oversupply of homes in the
Pick
interim?
your time frame, whether it's probably not in 5 years, but 5 to 10 years. I don't think it will
Interesting.
be the issue it is today.
Yeah.
And then, Paul, you can go down a path of what's is is and I see or I hear a lot of young people. I'm still a believer. I have two young kids. One owns a home, the other one does not yet. But when I listen to the younger one and his friends talking about it, they're not necessarily convinced at this age they need to buy a home and that's the best use of their down payment money. That's not how I was raised. It was get a house as soon as you can. And I think a lot of proceeding. So I think it's just an interesting, we'll have to see how that plays out with the young folks. And if they are willing to sacrifice and be house poor for a period of time and sacrifice a lifestyle that they like versus renting for a period. So we'll
Yeah.
see. So I don't know if there's the same demand influences, and I certainly see as cohorts kind of shift and age differently, supply coming back on market.
Yeah.
So
It is a really interesting time. I think you also have, you know, let's add to that mix the great migration, right? So you have people that are
yeah,
not necessarily working where they live. You also, and I'm also seeing, and this was in the headlines, And I wasn't quite, I couldn't quite put my thumb on it, but now I'm seeing it more and more where you're seeing multi-generational homes, where, the generation just under us, I'm going to clump you and I together, John,
Thank
that
you.
parents that live, with them. And even my husband and I talk about the fact that like we're having open dialogue with our children that, well, yeah, you very well might be living in our guest house when you're 30. Like that's okay now. And so it's not that we're necessarily thinking about it, but it's that that's in conversation
Yeah.
where homes are becoming where, almost like what they used to be like in the early 1900s, where a home was in a family for a while. Multiple generations were in that home.
I grew up in Vancouver, as you know, but very expensive city. A lot of immigration over the past, really forever, 100 years, but let's call it in the past 20, 30 years. And you will see that just given the pure price of homes, three generations living in a home.
Yeah.
And you'll see it in other parts of the world. So, whether or not that happens here, obviously, those of us in the home industry probably want to see more product and more supply and more business.
Hmm.
But it's interesting to watch. I'll give you one last one here if we have time for it, but and just kind of from my um, at the MBA side, and I think people are a little bit aware of this, but it will be interesting how it plays out is the Basel III endgame bank capital standards. So uh, the vice chair, Michelle Bowman, just issued that maybe a week or so ago.
Yeah.
It's now in a comment period. And really, without getting too technical, it is proposing to relax in many ways a lot of the capital and regulatory standards for banks.
That's it.
Specific to our industry is around MSRs and owning whole loans, et cetera, potentially warehouse lending. So um, that could be an interesting shift. And part of this is banks since the Great Recession have really pulled back to some degree, or even
Yeah.
to a large degree, depending upon the bank, out of the mortgage space. And I think, you know, people in the government and some of the regulatory bodies like having the banks in there, given their structure. So trying to make the asset a little bit more favorable for them to hold, which helps the liquidity of the asset and the demand for the asset. So net probably good for the industry overall. But that's also an interesting one that is in the headlines if you're reading bank headlines or regulatory headlines, but not necessarily probably a day to day for an IMB.
That's really interesting. It's a fascinating time. So many things are changing. And with the movement of technology, and dare I say artificial intelligence or AI, it's causing things to move quicker. Because you've got access to data, you have access to change technology with artificial intelligence, and you have access to market to a said segment a lot quicker with AI and the way social media is working. So I think as we're seeing these trends change, we're going to see changing trends quicker and quicker. That being said, technology guy. So obviously advocacy and legislative guy, but also technology guy. So let's jump into a question or two about technology, and let's talk about first technology as an infrastructure, not as a feature, but as an actual infrastructure. There's so much noise around automation and AI, but ICE sits at the infrastructure systems that lenders depend on to run their organization from A to Z. It's great, but it's also a lot of pressure, I'm sure. What does durable technology investment look like versus short-term experimentation? So when you're talking to your potential partners, how does ICE position as a long-term play versus an investment of a short-term play and being more on the experimental side?
Yeah, I like that question. You know, given the way that ICE Mortgage Technologies was brought together, and then over the past 4 years, what the teams have spent time on is enhancing and building complementary software. So how we like to look at our technology for the mortgage space is really an end-to-end ecosystem. So not even starting at, an LO standpoint, we have products on the real estate side of the equation. So from realtor to LO into originations, into closing, into servicing, through capital markets, and ultimately to the end investor. So when we're, talking to clients, that's how we think about it. And then as we think about, you brought up AI. When I think about AI for us isn't a bolt-on kind of a feature. It's embedded in the process. It's helping run the core technology. Um, and it's just helping it to run it better, faster, differently than we've ever seen before. But it's not an extra, if that makes sense.
Hmm.
And, I love all the startups, and they generally are going to push the envelope, and they're going to push companies that are larger and probably more stabilized to think about it and go in that direction. I'm not so sure we'd ever be on the bleeding edge of stuff because our clients can't afford that. And by that, I mean,
Great point.
we have a lot of banks, we have a lot of public companies, and I'm just not even saying ICE Mortgage Technologies. We run the New York Stock Exchange. Again,
Mhm.
there's millions of transactions a day, and we can't be out there kind of freewheeling anything. So the we take at our core, and our clients rely on this, but we take at our core the security, the cybersecurity, the regulatory, the compliance, and try to be very thoughtful in our approach. But that's how I think about it. The other point, though, that I think is important for our originator friends out there is how do you think about technology? So that's how we think about it. But how do I think about it when I was running AmeriHome or other companies, or how do other business leaders out there? And there's always this shiny object out there. And I do see some companies get caught up in that and they think they're being innovative. And really, they're just being very short term about their approach. And I think with tech, you need to sit back and first think about what I'm doing with my business. Tech is an enabler. We're not tech companies, we're mortgage companies. So tech is an enabler. And how do I need tech to help me run my business more efficiently, faster, better service for my borrowers, lower the risk for myself, for our investors, et cetera. And so it's a very strategic decision, and then I think about, well, who is the best partner for that? What risk can I live with? What can't I live? By risk, I mean, startups, they could go out of business. Risk could be, cybersecurity risk.
Hmm.
Risk could be just how long it takes to implement that.
Right.
So risks are very personal to whoever the buyer is, and there's a full gamut of them. But I try to have people think that way. And then ultimately, I think with tech, to your earlier comment, Paul, the speed that it's changing, you need to, as a company leader, and really create a culture in your company and a DNA that we are always implementing. Because I see too many companies out there, they get done an implementation, whether it's one of ours or somebody else, and then they sit on it, static quo, for 3, 4, 5, 6 years. Guess what? The world's moving and you are now behind the curve. Now, next time you want to do something, it's probably going to take you twice as long and be much more complicated. So I encourage people to just think that you always need to be continually improving your process and your technology.
It's evolutionary, right? Like it's evolving. And so when you think about, we talk about this with advocacy consistently at the California MBA, but when you think about evolving, you don't just evolve once. Like evolving itself means continuously evolving, growing, and innovating. And because technology is such a strong portion of multiple industries, but also, the mortgage lending industry is so complex. When I was just on stage with a few of our fellow lawmakers, or not fellow lawmakers, but lawmakers, even just explaining to them, and they know, but the structure of lending, whether you're an FDIC insured bank or a retail bank or an IMB or a like it's just also different. So the technology is really needed in our industry, but to your point, technology evolves. And so if you're not evolving as a user of technology, with the technology, it's going to surpass you, and you lose that point of why you have technology, really.
Yeah, it's just it can't be, we did a big project 5 years ago and now we're gonna sit on it for 5
Yeah.
years. And I would say a lot kinda do that, right? They run their
Yeah.
contract, they look at it, but most companies, including ICE for sure, we're continually enhancing and evolving. I'm not talking about releases, I'm talking about new product features within
Right.
something you're already paying for, that you could, you know, focus on and do, and that's how you're gonna get there. And so is it bit by bit, continuous improvement, or am I gonna every 3, 4, 5 years make these big leaps? Neither's wrong. I would probably lean to the bit by bit because I think it's easier on your staff and your customers and training and learning. And you reduce your risk of a major event, which really has risk both to your customers and to your staff and just to having operational challenges because this stuff can be challenging.
It is. It is. John, I have one more question that I want to ask you from a leadership perspective. So I know we're getting close to time, but I want to get this out to you. You sit at the intersection of markets and infrastructure. When you look 5 years out, what do you think the industry needs to get right now in order to remain resilient? Where does our focus need to be?
Um, hmm, I got a couple thoughts. So one, when I think about it from an industry perspective, and maybe because of my current role at ICE, but even at the MBA is in that role. Um, we need to figure out how we're going to regulate AI. And some states are starting to. Federally, we haven't. And the last thing we probably want is 50 states with different rules on AI, which is a little vague in terms of what that means and feels like, as maybe some of the audience will know. Was that 2 years ago, 1 year ago, or we're still fighting it, Paul? But there was a bill proposed in California that would have probably made DU and LP illegal,
Yeah, it was last
right?
year. It's here again, 1018,
Yeah.
the 2-year bill. We're having fun with it.
Yeah, so, I mean, so that's where, the whole concept of AI can be a little vague and not well
Yeah,
understood. And, so I think just from an industry, and that's very specific, maybe more specific than you wanted, but that concerns me, and we need to kind of get there. Obviously, federally, they appear to be focused on a few other things right now.
yeah,
But we have talked to them. It's on certain people's plate when that comes up. And then the challenge is we don't, is it a state function? And, we're a federal republic and we're not supposed to tell the states what to do. And so they respect that. So I'm not so sure we're going to avoid the 50 state type of a solution, but that will be it. Back to your earlier comment, another challenge for lenders out there.
yeah,
But, people could be implementing things today and using them in their business that ultimately could be illegal or outside of regs. So I think of that as an industry. I also think um, the whole cost thing's a very interesting one. Every company throws around the $11,000 per loan kind of deal.
mhm, mhm.
Um, and it's great marketing if you're a company or an AI company and you say that it no longer costs us 11,000, we can produce a loan for 1,400 bucks or 1,200 bucks. Well, no, you can't, and you're eliminating some stuff out of the denominator. The 11,000, 60+% of that, 65% is LO and sales commission and expenses. It's not the raw production cost of that loan. Let's call that 3,000, 3,500. Um, and how do we get that down through technology? The biggest driver when that number comes down, when those stats come out every quarter, is if companies are busier. So it's a scale number because you're
Huh.
covering fixed costs over that. So the second we have a little refi boom, you will see that cost per loan go from 11 to 9. Nobody did a thing other than the people got busier and pushed more widgets out per hour or per day.
Interesting. Yeah.
And so, I think it's a misleading kind of a deal, as we talk about in mortgage. Averages will kill you. You'll lose your business if you look at averages. You got to look at the tails and understand the details. And I think about that with our cost per loan. $3,000 a loan. Okay. You do a little more volume, that's $2,000 a loan.
Hmm.
Your technology cost is 650, 850 a loan, something in that range. Is that a lot if it's giving you a 2, 3, 4, 5 ROI on reducing that cost? It's kind of peanuts in a sense. And, I think a lot of people would pay double if I could reduce the 3,500 by half.
Right.
Right. So I think that one we need to get our head around. I think we were tired of right sizing. We did it for 3 years, and so I think I'm not hearing much of that anymore, but I still think, what's going back to my economics class, we're not at peak productivity, marginal productivity. There is, and you will see that. People won't hire necessarily if we have a little spike when rates went down, into the high fives and productivity pops up. Great, right? So we're not yet, and we still need to get to that. Technology is going to help companies get to optimize productivity more often than not. But if you took an average year with an average company, what are you in, out of 52 weeks? Are you nailing your productivity metrics and your staffing right 8 weeks, 10 weeks out of the year? Half the time, the other time you're either over or under and over, and now I'm paying overtime. So I think that's another area that as an industry that has to come down. So I'm not disputing the 11.
Mhm.
I think it's a little overstated today, given the volume that we have, and there is flex in that system. And again, technology will help people become more scalable. And by that, I mean, I go up 30%. Instead of hiring 10 people, I need to hire 2.
Right.
And also means when it goes down, I don't have to fire 10 people, which we hate to do.
Right. Yeah. So, amazing perspectives, John. I appreciate your thoughts, how you look at things, your leadership. Um, it's thoughtful, measured, and very forward thinking, but not so out of the box that people can't listen and obtain what you're saying. So I want to thank you for your time. These conversations are so helpful to our members to think beyond what's occurring today and what's the position of today's market, and what that means to rates and what that means to productivity and volume. I also want to thank you for your leadership to the California MBA, what you bring to ICE, the industry, and personally me. I've reached out to you many times in my new position as CEO of the California MBA, and so I want to thank you for your time here today on this Connect podcast, but for your participation and your leadership in the industry as a whole. To our listeners, thank you for tuning in to Connect. Stay engaged, stay strategic, and keep building with purpose. Thanks again for being here, John.
Thank you, Paul. Appreciate it, buddy.